Okay, we are recording. Let me just check the size of the screen. Okay, we are at 100. Okay, so this is where we were, underlying position, underlying key risk factors. Okay, so I think we have to start from key risk factors. Hedge transaction, hedge position. We have done that as well, right? We have done this as well. Let's quickly go through key risk factors. And now let's look at your case as well. Also, we'll open your case. We'll start the case now so that you have a look at this. So what will happen is in your project, what you'll be doing in your project is those several contracts that I gave you earlier. With those contracts, you'll be looking at the case. Today we'll start looking at the case and the notes together. We'll just give you a brief idea about the case. So the way you're supposed to do this is first, we'll look at the case, see what is involved in the case, what we have to do. I'll add some more questions as well later on. Okay. And then we will come back. And so the idea, the structure of this whole case exercise is that we read the case, we understand what are the problems we have to deal with. These are the questions you have to answer for the risk man, the treasurer of Magma. Then these are the questions you have to answer. So in order to answer these questions, the kind of concepts that you need to understand are given here. Okay, one more thing today is that from today onwards, I will not be looking at the chat box. I'm not going to be opening the chat. Okay, so if you have anything, you want to put some message there, you can put it. If you want to record the fact that you were absent or something like that for got cut off because of power cut and all, put it there. I'm not going to open it, okay? So if you want me to do something like I'm not audible or something, you have to get somebody to tell me, interrupt me in the class and tell me, okay? I'm not going to be opening the chat box messages because it's very distracting. Okay, so we're going to look at the case. This is our case. And then we'll come back to the note that we have. So the technical note, essentially, this is a new kind of concept for you. So far, you've done cases which did not have technical notes, but some of the cases in finance and even in maybe operations might have technical notes, which is a piece of it's like a book chapter which teaches you certain concepts which you need to apply in order to solve the problems in the case. Okay, so this is what this technical note is, which we've been studying so far. Now let's look at the case and let's try to understand what you're going to be doing, and this is what you're going to be managing in the project. Okay, so this is the case of corporate treasury risk management, which means you're managing a passive risk book. You'll be managing it. So far, your first two projects, US equity trading, cash equities, and the second project, US equity options trading. These are both examples of active risk books. You start with zero risk, we give you some capital, start with zero risk, and each of you starts taking positions, adding risk assets, and creating risk on your books because you want to make some money. In the case of a passive risk book, you already start with some risks because, like, for instance, in this case, this is a diversified mining and energy company. Okay, so here you can see, and so this is a mining and energy company. So because of the kind of business they're in, they will have certain risks in terms of their exposure on the input purchases front, on the output sales front. In this example that we have, we're going to open the balance sheet. We'll open it from here. This is inside your here we are. Okay. Now, why is this view only? Maybe I've just logged in this. Okay, this is never mind. We'll deal with it. Okay, that's because this is the student version of the case. Okay, so that's why it's view only. Okay, so we'll try to reduce this. I'm so accustomed to be seeing my version. Right. So here you have this mining and energy company with the kind of concepts that we are covering right now are key risk factors. And then we are going on to hedge transaction, hedge position. Okay. This opposite offset part of it that we discussed. Okay. Um, Let me just go back to the top here once and see the layout of the topics. Okay. We've got the, this is actually not a correct, this should not be this is not a subtopic. Types of hedging programs, decision problems in hedging, passive risk books, project, goal, hedging logic, the golden rule of hedging. Okay, so yeah, so I think what we'll do is let's try and understand this balance sheet now. So far, based on what we have understood, we've already covered key risk factors, and we've also covered hedge transaction and hedge position. We also covered the previous notes. Okay, so key risk factor, remember, it's just a fancy name for a price. Okay, it could be the price of dollar yen, it could be the price of the crude oil, it could be the price of crude oil. So it's just a fancy name for a price. So and any change in the price which causes changes in the value of assets, liabilities on the balance sheet. This is one. And then you have, of course, underlying position as well, which is going to also determine what the key risk factor is. Basically, the underlying position, the market in which you have a underlying position, that will become the key risk factor. Essentially, that market price becomes the key risk factor. And of course, markets, as you remember, always discussed as a market instrument combination, right? And then you have hedge transaction and hedge position. So let's get into the case. Let's try to understand. So we have this diversified mining and energy company, okay? And you've got the stylized balance sheet. A stylized balance sheet essentially means that this is an example of a stylized balance sheet. We'll just go down a little bit. Maybe we need to make it even smaller than this. Okay. Yeah, this is better. All right. So here you can see that the assets are quite, the stylized balance, the word stylized means that it is, it's not the full balance sheet. I have taken certain key aspects of the balance sheet and created a kind of a model balance. I mean, it's like a kind of a bare bones balance sheet showing only the important aspects that I want to highlight. That's what is meant by stylized here. Okay, so here you can see everything here. I have not put plant and machinery, mines. It's a mining and energy company, so it will have mining infrastructure. Okay, so it will have whatever, you know, the places for the laborers to rest and all that. All that I've not put. Plant and machinery, all those things are not here. I've just put certain key assets with which we are concerned, okay, in this project. So that's what I put on the balance sheet. So you can see here what is there. You have assets, okay, which are gold, copper, and crude oil. Okay, this is the inventories that this company has. These are the inventories. And then you have on the liability side, you have a loan. You have two loans, two types of loans: yen loans, Australian dollar loans, and US dollar loans. And then you have, of course, the equity part of it. Okay, so you see the total balance sheet size, 7 million. Then you have, so it's deliberately kept as a small balance sheet. Normally, a company would not have such a small balance sheet because it also has to be consistent with your, you know, you have only have about $1 million of capital in the, $1 million of invested capital in the Interactive Brokers account. So when you use that to hedge this balance sheet, I might even make it even smaller for the project trading part. But for the understanding of the concepts, we'll keep this kind of number, and that'll help us to understand the concepts. So this is the balance sheet. First, understand the balance sheet of this company. Assets. All assets are only showing current assets. So normally you would have on the asset side, you would have current assets and fixed assets, okay, non-current assets. But here we are showing only the current assets, and current assets also are split into, obviously, if you remember your accounting, okay, let's go into, we are here, what is today? 19th Jan. Okay, right. So you have, let's quickly recap. Many of you may not be clear, although this is very basic stuff. The second year of an MBA program, we should not have to deal with these questions, but I know that many of you are not clear with your concepts. 1 minute, what happened here? I got one here and I got one here. I got two of them. Okay, right. All right. Let's put this here. Okay. Right. So normally on the asset side, we would write assets. We would write current and non-current. Okay. Right. And then current, we would further break up current into. Current would be further broken up into cash and there is this term that we use, cash and marketable securities. So I'm just going to write MS, okay? This is called cash and marketable securities. Then you have inventories, and then you have accounts receivable, okay? So you see how stylized this balance sheet is in comparison to normal balance sheets. Maybe we should put it here because it's going too far out. Right? Okay. And then you have current, non-current. In this case, what you're seeing in this balance sheet is you're only seeing the inventories part. So you're not seeing any non-current assets, and even in current assets, you're not seeing any inventory. You're not seeing any cash, and you're not seeing any accounts receivable. Okay, that is a deliberate trick, because the objective of this case and this balance sheet is to teach treasury risk management. And in this particular example, we are talking about because those receivables are actually very hard to manage. It's very hard to manage risk on. There is credit risk on accounts receivable. When you have accounts receivable, there is obviously credit risk. Okay, but this credit risk is very hard to manage. So therefore, we are not putting it on the balance sheet, because if you can't manage this, what can you really do? Okay, all you can have is a kind of diversified customer base. You don't have your own type business being so all dependent on one customer, and those kind of techniques. But in general active risk management, there is very little you can do to manage account receivable. You can manage inventory risk, and cash and marketable securities, there is not really much risk. On the marketable securities, you may have some risk, some interest rate risk, because usually they don't invest in equities. Here they put the most cash, extra cash, they put into treasury bills and stuff. So there is some element of interest rate risk. So if you look at the current asset mix of a typical corporate, the main risk management is with respect to inventories in the case of commodity trading companies, which is what we are looking at. Okay, and then there are other and then the other risk is on the liability side, which we are putting in here. That's why this balance sheet is structured the way it is. Okay, so if you're wondering why this non-current assets are not there, this is why it's not there, because the purpose of this case is to teach treasury risk management, and there's not much you can do to manage accounts receivable, and cash has very little risk. Okay? If we go back to the liability side, who is not on mute actually? Okay, guys, please make sure that everybody's on mute so that we don't have this echo problem. All right. Okay, so here you have On the liability side, you have, so here on the asset side, you have these three types of inventories. You have, I'll just explain the how to read the columns. This is the price of gold, okay? This is the price of copper, and this is the price of crude oil. It's not a very user-friendly way of writing it. I guess we could make the balance sheet look a little bit better, but I'm just telling you how to read the layout as we have it. Then, of course, these are the units. So you got 2,500 ounces, troy ounces of gold at a price of 1510 in 81, and that's why you see the market value. If you can see, I know you're not allowed to do F2 when you have view, but you can see it is B7 into A6. Okay, A6 is the price, and B7 is the number of units. Okay, so the market value is derived by multiplying the units into the price per unit. Okay, so this is how you have the market value. So these are the key aspects of the asset side, and you add up all the market values on the asset side, and you get the total balance sheet size on the asset side, which is obviously matched on the liability side. Now, on the liability side, what we have is, of course, this is showing you how the assets of the business have been financed, how exactly it's been financed. So you have, this is where basically the broad split of this, when you conceptually look at it, it should be essentially owner's equity, and which is also known as net worth, owner's equity and outside liabilities. So just to remember once again, your classic split of the liability side should be, since we've got it like this, we have to put it now. Most of the balance sheets these days come like this, okay? We are used to writing, actually I learned the balance sheet with the assets on the left side. So I always put it like this, but most of the time people put the assets on the right side. But anyway, so it doesn't matter which side you put it, but anyway, it's better to put the assets on the right side because that's what everybody's doing. Okay, liabilities. On the liability side, you would have owner's equity, okay, net worth, which is called net worth, and it's also called share capital and reserves, okay? So I'm calling it SCNR, okay? So share capital and reserves is what we would call it in India, say, or in the US markets, you would call it owner's equity, net worth, okay, international markets. So the general terminology should be, on the liability side, you have this, and then you have what we call outside liabilities. Okay, there's a peculiar term that comes. This is a finance term, okay? In law, we don't talk about it like this, okay? Or even in, so in finance, we would talk about it like this, finance and accounting, that it is outside liabilities because it is liabilities to the, maybe it's a center, it's an alignment problem, okay? So not very well written. Yeah, so we would have owner's equity, net worth, this, and then we had outside liability. So what you're seeing there, I'm just recapping some of the basic balance sheet concepts because we want to make sure that, because I know many of you are still weak on, even the fundamentals, although you don't say anything in class, but it comes out when you write the answers and things like that. So I'm just recapping some basic concepts. This is how you should think about a balance sheet. Even if you see a bare bones balance sheet, a stylized balance sheet like this, you should still always see that, okay, when you look at this kind of asset side, you should mentally imagine, the way you should be thinking is as follows. When you mentally see when you see this, mentally you should imagine, okay, what has been done here? Assets should have been current assets and non-current assets, but non-current assets have been stripped out, and under current assets, we only see inventories, we don't see cash, and we don't see accounts receivable. This is how you should be thinking when you look at this balance sheet. And then you look at what's on the balance sheet. Again, on the liability side, you should think of this. The broad split would be two parts. These three loans, imagine they're in one box, and this net worth figure is in a separate box, okay? So that's how you have the split of owner's equity, net worth, share capital, reserves, and this whole set of three loans will constitute outside liabilities. The reason it's called outside liabilities is these are the liabilities to the owners, these are the liabilities to those who are not the, in finance we use the word owners to refer to shareholders, although that's not really correct. They're not owners. The company is a separate entity. They're actually, in this case, to understand why they call it outside liabilities, you will have to understand that in finance we refer to shareholders as owners. But in law, we refer to them as members or shareholders. So the legal perspective is the correct perspective, but we just remember that in finance we use the term outside liabilities because these are the liabilities to people who are not the owners of the company. The owners are kind of like insiders. Okay, so these guys are the debt holders are referred to as outsiders. So therefore, outside liabilities. Okay, so this is a broad split, and then you have this net worth. Okay, as you will see, if you see the formulae, there will be this is G13. G13 is this one. Okay, and this will be a residual. If you see, the residual is H5 minus I7, I9, I11. What is H5? Look at H5. H5 is nothing but the total liabilities, which itself is equal to C5. Okay, C5 is this, which is the total assets. So you look at how the formula for net worth has been calculated. I'm sure you know all this, but I'm just recapping, and just in case anybody has any, weak spots here. You take the total assets. Okay, the total liabilities must equal the total assets. And what is the net worth? The net worth is nothing but total liabilities, that is H5 minus I7, I9, I11. What is I7? I7 is here, market value of the yen loan. Okay, so basically you can put I7, I9, I11 into one, which is I7 plus minus brackets, I7 plus I9 plus I11 close brackets. So basically that would mean that total liabilities minus outside liabilities, okay, or total assets minus outside liabilities would give you the net worth figure. That's what you have done here. And so your total liabilities, which is equal to total assets minus all the outside liabilities, where you have added up the market values of the three loans. So this is your net worth figure, right? So the real dynamic of if you look at now, this is how you should understand corporate treasury risk management. The goal is to maximize the net worth, okay? Through the goal is to maximize the net worth. And now make sure, so how does that happen? How does the net worth get affected? Obviously, you can either have, so this net worth, if you understand it as total assets minus outside liabilities. So either the value of the assets, if you want your net worth to increase, then the value of the assets should increase, or the value of the liability should decrease, or both. Okay, so that's how your net worth goes up, because this is total assets minus outside liabilities. And so obviously on the other side, that's what you do if you want your net worth to increase. And since risk management is mainly a defensive activity, remember, a hedger's goal is to reduce risk. So it's a defensive activity. So another way of looking at the whole risk management problem in the corporate treasury is to protect the net worth, prevent the net worth from going down. Okay, so therefore you can look at it this way. So do whatever you can. Net worth will go down if asset values decrease and liability values increase, because this is total assets minus outside liabilities. So if asset values decrease and liability values increase, then the net worth will go down. So your goal as a hedger is to do, you can't really touch the balance sheet. You can't just say that, okay, let's sell some copper. It doesn't work like that, because the way that corporate treasury risk management is done is, this is where this idea of the hedge position is going to come in, okay? We got the underlying positions, yeah. The whole idea of the hedge position is going to come in, where you see that, this idea. We can put this whole thing. pick a nice light color where it stands out. This gives you the central idea of hedging. Okay, the central idea of hedging is that you do not actually touch the balance sheet. You can't touch the balance sheet. This is not how hedging is done. Because this is, remember, this is a business. So when these guys, the copper mining operations are part of the operation, the mining operations. So the way the copper mine works is that, you take copper out of the ground, you refine it a little bit, you get it ready into the form that the users want it in. And then you arrange for your sales. Your sales team will be talking to the customers, and then they'll contract, they'll finalize the price, and then they'll set up the they'll finalize the price and terms of contract, and then the delivery dates and everything will be, the settlement dates will be set, and then the copper will be shipped to them. So once you settle into the contract, then your market risk will be removed. Here we have assumed that all the stuff on the inventory, okay, on the showing on the balance sheet. This is kind of like an economic exposure balance sheet. So this may not be the actual inventory on the balance sheet. This would probably be the total amount. This would be the total amount of inventory that these guys have left, which is bound to come on stream, but has not yet been sold. When you sell it, it's no longer risk. Okay, so of course you could have credit risk, but that would go into accounts receivable. Okay, once you go into, so that becomes a separate kind of risk management, which we can't do actively. So the point here is that you can't, the point I was trying to make is that when you do risk management in corporate treasury, you can't disturb the balance sheet as such, or even the economic exposure balance sheet. You can't disturb it because the economic exposure balance sheet, which we checked the other day, like this, that all the sales quantities these are all the projected production finished goods inventory, which is likely to come on board. And you're pretty sure about this, okay? Because you have a business which is operating for many years. You know the seasonal patterns of the business, okay? If you were trying, for instance, if you were hedging crude oil for India, if you're on the crude oil hedging team for India, we know, of course, now COVID is a different kind of situation, but we have an idea about, normally GDP doesn't, because of COVID, GDP has dramatically collapsed. But generally, the GDP does not move that sharply. It moves in a very slow manner, okay, up and down. So we have an idea roughly how much oil we are going to need to consume every month, okay? So they're based on those core consumption. So if you are consuming, let's say, if you're likely to consume 650, but then there's a kind of a core consumption always there of maybe 500. So you would maybe put 500 over here, because that core consumption is bound to happen. Okay, so you put a core kind of position that is going to come up. So your entire economic exposure balance sheet, but you can't actually. The idea behind hedging is that you can't disturb the balance sheet because these are showing the normal underlying business operations. So when the sales team is trying to contract with the copper customers, going into, they will enter into negotiations, how businesses operate, okay? So you can't just force the customer and tell the customer, look, I've got a lot of unsold inventory on my books, let's quickly conclude the contract. That's not how the customer operates. So you got to have, your business has to be totally focused on the customer. And how the customer you have to basically arrange your whole service and product offering around what the customer wants, what is convenient for the customer. So basically the customer experience, if you go back to a business strategy concept, the whole thing is about customer experience. If you look at a company like Amazon, how it has become so powerful, because they have only one thing, they only think about one thing, customer experience, and they're delivering everything for customer experience, and that's why they've got this kind of loyalty, and that's why they have this kind of market power. So therefore, you do not disturb the business, you do not disturb how the sales team operates and contracts with the customers, but you see that you've got this much risk on the books. You better do something about it, because in this case, if something happens, we're going to ask you those questions, but if something happens to the price of copper, then you're going to have a problem, because you may end up losing money. So therefore, your net worth might go down. So you have to try and prevent that from happening. So therefore, we want to make sure that, so what we do is, Well, we have to do something about it, but at the same time, we can't touch the balance sheet. We can't do anything on the underlying balance sheet. Now we set up, this is where the concept of underlying position and hedge position comes in. So it operates like this, let's put it this way. It operates like, okay, so you have underlying position. Maybe we can show it as a, we can show it here actually. So let's have underlying position. Spelling is not correct. And then you have the hedge position. Okay, so the idea is, all right, so if we have this in, if this is, let's say in red, and this we can put in, right, and this we can put in green. So red and green are contrasting with each other. Okay, so this is how you think about it. Okay, this has to be an offset. The best way to, this is an offset. You understand what offset is? Okay, basically counteracting the effect of the other. Okay, one offsetting the other. So underlying position, this is what you have. This is your, these are your underlying positions on the balance sheet. But from a hedging perspective, when we want to use this framework of underlying position and hedge position, right? And we talked about total risk. Remember, when total risk is risk on the underlying position plus the hedge position. That's why we talk about total risk. In the case of a active risk book, like your first two projects, there is only generally this. There is no, we don't really hedge on active risk books most of the time. Sometimes there is an exception, of course, which I've described in the options trading note under the relationship between the VIX and the S&P 500. That part of the note. We've talked about how there could be hedging on even in an active risk book, on a fund manager's books. But in general, we do not talk about hedging on active risk books. Active risk books, you just buy and sell. If you feel something's going down, you just sell it. You don't hedge it. So on active risk books, there's only the underlying position, okay? There is no hedge position in general. But on a passive risk book, like the corporate treasury book, you have two positions. So what you're going to do is you're going to look at this. So the basic mindset of hedging is like this. You assess the risks on the balance sheet, you study the balance sheet, you figure out the risks, okay? And then you just realize that the goal of your hedging program is to prevent the net worth from going down. Because if net worth goes down, what happens to the P&L? Does it go down or up? When net worth goes down, in that period, the P&L would have gone up, or net worth going down is a result of P&L going up or down?
P&L is going down.
Down.
P&L is going down, so you don't want, right? So therefore, you are basically focused on preventing the erosion of net worth. So you look at the balance sheet, you study the balance sheet, you set up an economic exposure balance sheet, you see where the risks are, what are the key risk factors which are going to, what are your underlying positions, what are your key risk factors, and therefore how you should be looking at the market and how you should be, if we bring back our beloved notes master file, we may have to open some of our charts. But if we go back to this, so this is the idea. So you look at the balance sheet, stylized balance sheet, economic exposure balance sheet, identify the key risk factors of the underlying position. So you're totally tuned into which market risks are affecting you. Okay, and maybe if you have exceptional cases where you have directly tradable credit risk products, then you would manage the credit risk as well. But mostly in treasury management, we are managing market risk. Mostly in treasury risk management, we are managing market risk. So, except in the case of banks where they have, a lot of credit derivative, credit positions, and they use credit derivatives to hedge those positions, that's a different kind of thing. Right now, we're looking at a non-financial corporation, which is not a bank. Okay, so like this kind of an energy and mining company. So you look at the balance sheet, identify the risks, and then you start thinking in this kind of framework. You say that, okay, this is my underlying position. I have to prevent the erosion of net worth. Okay, so my total P&L will be, net worth will erode when there is a loss on the P&L. Okay, but the total P&L is basically, this is where you understand that your total P&L is made up of, total P&L is made out of underlying position P&L and hedge position P&L. Okay, so this is equal to this. Okay, position of the underlying position P&L and the hedge position P&L. So whatever happens to the market prices, you will be watching these the key risk factors, and if you feel that the key risk factors might go down and the underlying position on its own might lose value, there may be losses on the underlying position because the key risk factors are moving, and it is moving in such a way that either asset values are going down or liability values are going up. In either of those two cases, or both. In those cases, your net worth is going to go down. So you can't do anything to the underlying balance sheet. You can't touch the underlying positions. But what you do is you set up offsetting hedge positions. So we'll understand how this works. I'm just giving you the theory first. We'll look at some examples and we'll try to understand how hedging works. Okay. So the main idea is that you try to set up offsetting hedge positions, which are offsetting what? The underlying position. So you try to do something as a hedge transaction, which creates a hedge position, which is what we have given you here. That hedge position should be opposite to that of the underlying position. Now, if you go back to the Hal Basu examples, okay, you can go back and read those examples where what they have talked about as a offsetting kind of transaction. But they haven't set out the theoretical context so much, but that you will get from this technical note. That why are they doing that? Why are they doing an offset? Because they want to. So once you understand this framework, it will become clear to you. Why are they trying to set up an offset? Because the goal is to maximize the total P&L. Maximizing P&L means also minimizing losses. Okay, so if you see a risk that underlying position might start showing losses, then you set up a hedge position in such a way that it is opposite to the underlying position, what we have given you here. Hedge position is opposite to the underlying position. If the underlying position is long crude oil, then the hedge position will be short crude oil. So that if crude oil prices fall and the underlying position loses money, the hedge position will make money. So the total P&L will not be affected if you have hedged 100%. The total P&L won't be affected because underlying plus hedge position will be setting off each other. Okay, so you'll see offsetting each other. If you read the book, you'll see that when you read the examples, you'll find essentially that the losses, if you're 100% hedged, the losses will be completely offset. So the total P&L is the P&L that matters, and so that will be okay. That P&L will be protected. Okay, so that's basically the idea. So that's why you have an offsetting hedge position. That's why you have to understand that because you can't touch the balance sheet, and the goal is to limit the erosion of net worth, which is consistent with the loss on the P&L. And the P&L is calculated as P&L on underlying position plus P&L on hedge position. You see a risk that the underlying position P&L might go down because some of these assets might go down in value, or some of these liabilities might increase in value. Okay, so when you look at liability values, remember that the balance sheet always is in some currency or the other. In this case, it's a US dollar balance sheet, but many of these are other currencies like yen, Aussie, and so we have to keep showing these as dollar equivalent values. Okay, and that's why the exchange rate becomes important between the two currencies, the dollar yen, Aussie dollar, Aussie US, etc. So these exchange rates are important, and these are all US dollar values. So you have to basically try to control the loss of the offset the loss that is going to happen on the underlying position, and that's why you have a strategy where you try to always create a hedge position opposite to that of the underlying position. And if you want this kind of hedge position, you know what kind of hedge transaction you have to do. Remember, transaction is sale or purchase. Position is short or long. a sale will lead to a short position out of a blank slate. Okay, out of a blank slate, a sale transaction will lead to a short position. A purchase transaction will lead to a long position. Okay, so we use these terms very particularly. We don't casually call something a transaction and then say it's a long. But actually, it's a long would be a position. A purchase would be a transaction. Okay, so this is basically the idea. So I think now you have some idea as to what actually happens, the whole hedging framework. So what I've explained to you is the entire hedging framework and the way you think about it. If you understand this, once you understand this, then you will understand why uh, we set up an offsetting hedge position. Okay, because also partly because, as I said, we can't touch the underlying balance sheet. You can't disturb the way the business is run. Just because the Treasury wants to hedge the risk, you can't start interfering with the relationship between the sales team and the customers, which must not be disturbed, because the business has to serve the customers and deal with and work according to their convenience. All right. So let's go back and have a look. You read the case, just read a few lines while I drink some water. Okay, we don't need to read that. Yeah. So what's happening is this: the case is centered on this new treasurer of Magma Resources. The balance sheet, you've already seen that. Now these are the questions. What we can do is we can maybe compress these so we can see more of them together. Okay. So assets have inventories of products that they're mining and producing. You've seen this: gold, copper, and West Texas oil. Okay, these are the quantum of inventories they have. And then on the liability side, we have cases of loans they have taken. On the outside liabilities, they have some loans. So this is the balance sheet currency is US dollars, and then they have some foreign currency loans. Right? So this is how companies borrow. What they do is they sometimes, ideally, a company should not actually take loans in yen and US dollars, yen and Aussie dollars, if they don't have any kind of revenues in yen or Aussie dollars. They should actually be matching. The conservative approach to managing risk is that your all your liabilities and assets should be matched. So you should only take a yen loan if you have some yen assets, like future receivables that you will get in yen, okay, which will be on the asset side. So if you're selling into Japan, you're getting a lot of revenues out of Japan, then it makes sense to take a yen loan up to that kind of amount. Like your core sales, let's say you're selling into Japan, maybe you're making you're getting about $1 billion of sales out of Japan every year. Then you can take up to $1 billion worth of loans in yen, because you're going to earn that money in yen from the yen customer, Japanese customers. So you can match the revenues against the payables, which is the loan, the dues on the loan. That is the general conservative principle of risk management. Okay, but that is not how we most companies operate, because they are not really that conservative. They take some risk. So many companies, you'll find many cases if you're following the Indian business news, you'll find very often that people taking loans. Airtel issued a loan recently. They'll take loans in US dollars, Swiss francs, etc. But they don't really have revenues in US dollars and Swiss francs, at least not up to that amount. So they take kind of risk because they feel that this is a low interest rate and they're willing to live with the risk. And so that's why they do that. So this is how most companies operate. They don't operate in the classically highly conservative manner, which I just described, where you completely match fund your liabilities and assets. You do not ever take the wrong kind of risk. Okay, so we can write this principle a little bit here also. Normally doesn't need to be in the case, it should be in the technical note, but I think I'll put it here because there isn't a clear-cut place in the note. So what we are going to write is that although, I'll write with capital and conservative, okay? Although so this term is called match funding. If you hear match funding, this is what is meant by match funding, where you match your assets and liabilities. And the assets are basically your kind of like a present value of your revenues that you're going to earn for the forthcoming year or the duration of the loan. Okay. So you match funding. Although conservative risk management can only take loans in currencies in which you're earning revenues, known as match funding. Yeah, so that's fine. We can close this here. We will make this long and we will make this okay, right. Now here I have given you the full context here. So now you can see that they have the reason that companies do this is because the interest rates are usually very attractive. Okay, so when I say favorable loan market pricing, what that means is that the interest rates on these loans must have been very attractive. Okay, especially in the Aussie and the yen. In the case of US dollars, there's no problem because their revenues are in US dollars, so there's no problem. You're not violating the match funding rule. But in the case of Aussie and yen, the reason the companies do it is that they get very good loan market pricing. So they have taken this is how you explain it. This is how you write it. You say taken advantage of favorable loan market pricing, which means basically that they got loans at a very attractive interest rate. So that's why they took it. Okay, so this is what companies do. But as we shall see, this creates a certain risk because you're violating the match funding rule. Okay, so that's why I've given you this particular other piece of information in the case, which is that the revenues are in US dollars only. Okay, this is an important piece of information in the case, that the revenues are in US dollars only. Now, normally what we would do is in a normal case discussion, I would, discuss with you whether I would not tell you this thing, match funding, right now, the way I told it to you. I would discuss in the class, okay, observe, what do you think? They have loans in Australian dollars, but they have revenues only in US dollars. Is this a risk? Then I would ask Rajat, then I would ask Saloni, what do you think? And this and so on and so forth. After asking everybody, then we would try to evolve something and come out with a solution that, they should only do match funding if they're very conservative, because otherwise there is a risk. So here you see the difference between the lecture tutorial method and the case method, okay? So if you're attentive, if you're a mature audience, mature students, and you're highly attentive, and you understand that it's not my job to make finance interesting to you, because you should already be interested in finance. It's my job to identify what is to be taught and to teach it properly. And so if you're listening carefully and you have understood match funding, then my job is done. I don't need to go through this waste of time that happens in a case, in this typical case method, where to explain one concept, you waste so much time. So therefore, you understand why I'm using some of these kind of teaching methods. and why I'm not, going through the case method. I understand that it's natural to feel like you're getting a little bit bored, but you have to guard against it. Because you have to understand what is the goal here. The goal here is I am preparing you to be outstanding finance students. In order to be outstanding finance students, you have to learn certain concepts, which I have decided what you should learn. Okay. Now I could be wrong. That's a risk you're taking. So you can't do much about it. Now, so I've decided what is to be taught, and I'm teaching it to you. So your job is to understand, pay very careful attention. If you don't understand, your job is to ask questions. You can ask questions 100 times. You'll notice I never fire anybody for asking questions. I've heard some stories where people ask, say somebody asks a question and people say that itna bhi malum nahi hai. So the student is actually kind of insulted. So the student does not next time the student won't ask questions. But I never do that. I always encourage questions. So you have to remember that you can ask questions anytime, as many questions as you want. So that is your goal. Once again, I'm reiterating the method by which we are learning, and you can see why I'm doing it this way. Okay. So we are here. Match funding rule has been violated by this company, like many companies do, and this is the situation. Okay, so let's see what the questions are in the case. So the treasurer comes in, and the CEO wants the treasurer to help him to answer the following questions with respect to the balance sheet. All right. So this is how the case has been set up. I'm going to just reduce this so we can see everything in one view. All right. So this is what is happening. So what is the first question is, what are the key, at any point of time, I'm not going to ask questions like any questions at this stage. If you have questions, you have to ask, just interrupt and ask me, okay? Okay, so the first question is, what are the key risk factors? We have already gone through the key risk factors, the theoretical understanding of key risk factors, which is here. What did we say? It's a price, okay, which will cause changes and which will cause changes in the value of assets and liabilities on a balance sheet. Okay. Now, here, since I've not opened we'll figure it out ourselves. We'll write it on the calc file and figure it out. Okay. So here the first question is, what are the key risk factors? Okay. So if we have key risk factors, okay, at this point we can do some CP activity. Let's ask, who do we have? Srishti, you have a question? Yeah, you have to, actually, why am I not able to see the hands? Okay, fine. Yeah, Srishti, what is the question?
No, sir, I wanted to answer the first question.
What was the first question? Key risk factors?
Yes, sir.
Okay, according to you, what are the key risk factors?
The future prices of gold, copper, and WTI oil.
Not futures prices, not future prices, but futures prices. Okay.
Yeah, the amount of future contracts basically.
Price. I know what you mean. You mean futures, but you have to be very careful because what came out of your mouth was future prices. Okay, so it's futures because the contracts are always referred to as futures contracts. We never say future contracts. Okay.
Yes, sir.
Okay. So, okay, 1 minute. Okay, let me just. Okay. So you have so anything else you want to say, Srishti? I'm coming to the others also. There are a couple of other people who raised their hand. There seems to be some problem with the hands. I'm not able to see it. What has happened to that? I had a view on in my panel. The hands used to show, but I saw that after Srishti, 2 other people had raised their hands, but I am not able to see them. Aman,
yes, sir. Double A
has raised his hand as well. But let me first finish with Srishti. Is there anything else you want to say, Srishti? You said futures prices for gold, copper, and West Texas are key KRFs. Okay, key risk factors we just refer to as KRFs. Do you see any other KRF here? And then let's see something else on the balance sheet. Some other, if we answer this, before we're answering this, actually, we have to give you some other information, which is, I didn't want to repeat the information, Therefore, we can actually, that's why I didn't put it in the case as such, I put it into the question. But let's put it into the case so that it's there as an information, okay, in the case. This should actually be in the case, but I didn't want to repeat the information, so I put it here in the question, okay? Let's look at it this way. Let's add two more pieces of information. The Aussie loan has, we're giving you some information about the loan side, and I'm bunching everything together because I want you to see, yeah, let's make some better use of space, you know. I can't afford to lose so many lines in just writing all this stuff. We'll just put everything into 2 lines. It won't look pretty, but it will give us more space. That's what we want, okay? I can't afford to waste so much space. All right. So I want to put now some more information about the loans. We are putting loan information on the Aussie loan. We'll come to AA. The Aussie loan has a 10-year maturity at a fixed interest rate of 5%. Okay, this is important. This information is important. The 10-year maturity at a fixed interest rate of 10%. These are the things you have to watch out for, okay? Fixed interest rate and 10-year maturity. And now what is the other thing information? The JPY loan has a 8-year maturity and a fixed interest rate of, we should actually do it here, 8-year maturity and a fixed interest rate of 2.75%, and then we're going to copy this onto the case, right? Here. So we are putting this information into the case, and so it is being duplicated in when we are asking the question, okay? And then the US dollar loan, let's talk about the US dollar loan. The US dollar loan has a 5-year maturity. Okay, so when you're looking at we're analyzing liabilities, you have to watch out for the maturity. And then you also have to watch out for whether it's a bullet maturity or we'll come to that later. The bullet maturity means that if it's a $100 million loan, then the entire 100 million is principal repayment is right at the end, which is how you studied bonds, bond pricing usually. But you also have certain other types of structures where the principal, like your housing loan. The housing loan is the typical housing loan is not student loan. Housing loan is not a bullet repayment maturity. It's a EMI has both principal and interest being paid down. Okay, so that's not a bullet repayment maturity. So you're familiar with the housing loan and the student loan. Those are not bullet maturity, bullet repayment of principal. So we write this. So for any loan, you have to watch out for right now. This is going to, we are going to put it there. All right, okay. Now this is the information in the case. And then you have the last line where the CEO is asking you to answer the following question. Now this is the important question. So now, right. So now I go back to Srishti and I'm asking her now, is there anything else that you see? You said that the futures prices for gold, copper, and West Texas are KRFs. Any other KRFs you see on the balance sheet?
Yes, sir. Sir, US dollars interest rate is not fixed and it is dependent on the fluctuations on LIBOR index. So that's also the key risk factor here.
Okay. Anything else?
No, sir.
Okay, fine. So that is Srishti, 1 minute. Okay, double A.
But I only think that the change in the price of gold, copper, WTI will affect are the key risk factors. The change in the value of asset.
Sorry, double A, what do you say? Change in the price of?
The price change that will cause the change in the value of assets of gold, copper, and WTI.
Okay, so what would you say are because the question is very specific.
The key risk factors are only these: gold, copper, WTI.
Okay, gold prices of gold, copper, and WTI.
Loan will not have any effect.
What will not have any effect?
Loan the 60 that 60 mentioned, that USD loan interest rate, that will not be a key risk factor.
Okay, fine. Okay, fine. So according to you, you have 3. She had
Yes,
4
sir.
and you
Yes,
have
sir.
3.
Yes, sir.
Okay, fine. 1 minute. Okay, next was Vipul also raised his hand. The hands are disappearing. I don't know where the hand. Okay, Vipul, yes, you had raised your hand.
Yes, sir.
Yeah. What is
Sir,
your?
the key factors are the futures price of gold, copper, and WTI. And sir, I think, sir, also the uh, exchange rate of uh, Japanese yen, Australian dollar with respect to US.
Okay, so you have 5, right?
Yes, sir, because sir, we have to make the bullet payment at the end.
Okay, fine. So yeah, the reasons I'm coming to later, but you're saying so your total of the KRFs is you've got 5. You've got the 3 gold, copper, and West Texas, and then you've got yen and Australian dollar exchange rate against the US dollar. Is that right?
Yes, sir.
Okay, you've got 5. Okay, 1 minute. 1 minute. Okay, so you got 3 other participants have raised their hands. Lots of hands are going up. Okay, let's see who. I'm always having this problem watching the hands because I've only got 2 screens. Actually, for online teaching, you need, I think, many screens, which is the way to go, I think. Okay, let's go to. We have Gaurav and Sachin. We'll go to Gaurav first. Yes, Gaurav.
Sir, I think Vipul is right.
Vipul is right. You're giving the same answer as Vipul.
Yes, sir.
Okay. All right. 1 minute. And you're not adding anything to what Vipul said.
No, sir.
Okay, 1 minute. All right. Okay. Next is Sachin. What is your view?
Sir, exchange rate and price of gold and copper is a
And
major key factor in this. Major
okay.
key risk.
And what about oil? Oil is not a factor.
Yes, sir. Matlab 3 of gold, copper, and oil. 3.
Yeah, because you mentioned only gold and copper.
No, sir. Sorry. All 3: gold, copper, and
Be very
oil.
careful. Huh? All these things. I'm just again. I'm criticizing people in front of others. Don't be offended by that. Because
No, sir.
the goal is to make you better. Okay. So even if you make one mistake, like even a comma is out of place, I will correct you. Like Srishti said, future. She did not say future, so then I corrected her because the correct thing is the correct expression is future. So I will make these kind of corrections, and obviously in front of everybody. So you should not feel insulted because I have to improve you as players. Basically, I'm like a coach making you a better player. That's all. Okay. So Sachin is saying Sachin has therefore what 5. You are the same as Vipul.
Yes, sir. Also, sir, exchange rate and asset gold and copper. Gold, copper, and oil.
You have 3, that is gold, copper, and oil, and then you have the 2 exchange rates, like what Vipul mentioned.
Yes, sir. Yes, sir.
Is that what you're saying? Okay. All right. Okay. 1 minute. All right. Is there anybody else with a raised hand? I want to see Sachin, Gaurav are done. Okay. And okay, fine. Gaurav's hand will go down. Okay, fine. So we are done with the participants right now. Okay, all right. Okay, so let's go through now. Let's see if there's anything else we have to go through in the notes. The key risk factors. Of course, first we have to understand the. Actually, I should have asked you the underlying position first. This is the second question. Okay. We can do KRF first and underlying position second. So let's first understand the KRFs. Okay. The correct understanding of the KRFs. Okay. So yes, so it is correct what Srishti said. There is a better form of the answer that basically you understand the market instrument combination. So you look at, you don't just say gold, but you say gold futures. In this case, as you know, you'll be hedging with gold. Actually, the real way is because when you hedge with when you was going to do the sale contract initially with with the customers. The correct answer is actually the spot prices, because usually the most of the contracts in the physical trade will be based on the spot price. Okay, but some of them could be based on the front month futures, also based on the things. So the futures are not really very wrong, but the right way to think about it is to think about how the business is conducted. Okay, so when you're thinking about, obviously the markets are fairly clear, many of you understood it, that you're concerned with the gold price and the copper price and the West Texas price. But which, if we try to here call up the bar chart futures prices, bar chart futures, they cause a lot of problems in terms of, they want you to log in every time. One sec. Yeah, let's see crude oil futures prices on bar chart. I think they have the cash market price. Okay, so the way to think about it when you're thinking about the KRFs, okay, the correct way to think about it is to think about how the business is conducted. Okay, so you need to be talking to the sales team so that you understand exactly what the KRF is. So you need to be talking to the sales team. The Treasury has to be talking to the sales team to understand how exactly they contract with the copper customers. So the sales, the guys who are going to be buying the copper. Okay, here you look at, we don't need the free bar chart webinar, but we can put this here. Look at the bar chart distribution of, so what I'm going to do is some of these points that I'm mentioning here, we can, okay, just we'll leave it in there. It will help give us more time. You notice here that the bar chart distribution of crude oil prices, this you won't see on the CME page, but here they have the cash price as well. Okay, so there's a cash market price as well, and which is basically the cash means here. The cash means does not mean that the transaction date is. It does not mean value cash. This is cash market as opposed to futures prices, okay? Because futures are derivatives and cash is the underlying, okay? So it's cash market in the sense of whenever we talk about derivative markets, we always sometimes refer to the underlying markets as the cash market. So this is the cash market in that sense, okay? So these are basically what we call spot market prices where you trade in tankers, okay? So the units will be maybe, it's obviously the prices in per barrels, but you could be trading in tanker loads. So there's a very active spot oil trading market, okay, for cargoes, which they're all, these big traders. You might have heard of names. Some of them operate in India as well. You have these big companies like Trafigura. So what I will do here, let me do one thing here. When I'm talking about some of these names, you should look up some of these names. Maybe I'll put it into the session notes. And then later on, we'll try to, at least it'll be there in the session notes. And sorry, I opened the attendance file actually, which is really not at all updated. I have to do that actually. I've taken all this data, but now I have to update it. Okay, so we'll try to write this in the session notes, but I'll just mention it briefly here, that you notice that there's a cash price as well, okay? So in trying to understand what exactly are the key risk factors, because remember that we talk about, whenever we talk about a market, we should talk about a market instrument combination. So Srishti's way of thinking is correct actually, that she has also been conscious of an instrument, not just a market price, but also that she has to mention an instrument, and she's very close to being right actually, because sometimes you can also take the front month futures price. Sometimes you take the front month futures price, but most of the time the trade contracts, that is how the sales team is going to be selling to the customers. Trade contracts are based on the spot price, which will be, in the case of crude oil, this cash price, which as you can see is slightly different from the even the front month futures price. Okay, so you have to understand, the basic logic here is it could also be the front month futures price. Sometimes they set that. So you have to, the basic logic is like this, that as part of the Treasury hedging team, you must be talking to the sales team to understand what exactly the KRF is. You must be talking to the hedging to the sales team, and to understand exactly the exact basis on which they set their prices when they're contracting with their customers. That is the key thing. Do they set their prices based on current spot or do they set it based on current, maybe second? It doesn't happen normally, second month futures, but I'm just giving a forced example. Maybe they set it against the second month future. Okay, so you have to first, so the process that you must follow as a hedger is talk to the sales team, find out exactly on what basis they're concluding the sales contracts to the underlying customer, to the trade customers. And that is what will be that particular answer to that. That will tell you that the instrument should be, okay, for the market instrument combination of the KRF. Is everyone clear about this? You understand this logic? Okay, that's what you have to think about. Okay, so let's assume that it is the front month futures price. Okay, let's assume for the sake of argument. Okay, so that in that case, your KRF is the gold front month future, copper front month future, West Texas front month future. In that case, okay, if it was spot, then it would be the spot prices for each of those. Okay, right? Now these are the KRFs on this front. Okay. Then we come first to what many of you said, starting with Vipul, about the exchange rates. Okay, that's a good point actually. That remember that you have, what is your concern? Always remembering the basic balance sheet equation. Net worth is equal to total assets is equal to total assets, which is the same as total liabilities. Is total net worth is equal to total assets minus outside liabilities, which is, so therefore you will take the dollar value of the total assets minus these three. So if anytime these two go up, okay, in this case you got two foreign currency loans. Here you don't have an exchange rate problem, because as you notice here, I've given the exchange rate as 1, because dollar against dollar the exchange rate is 1. Okay, but as you can see here, the Aussie loan here is 69.79. This is the Aussie rate, exchange rate, and the dollar yen is 109.44. Okay, so here what is the risk? If you go back to our beloved chart, which we have here, okay, so this is a correct example, the correct point that Vipul and others have highlighted, that the exchange rates are also a risk. Okay, so here you can see, so and so therefore basically anything at this point we will only leave it as a very general statement, because that will be answered in the underlying when we come to the second question, which is the question about what is the underlying position. What are the underlying positions? Okay, the KRF is very closely related to the underlying position. The KRF basically makes you zero in on certain markets. You look at it, you look at the balance sheet, the stylized balance sheet, economic exposure balance sheet, and then you identify the KRFs on the asset side. You identify gold futures front month, copper and West Texas all front month futures. So immediately you start watching this stuff. Okay, immediately you start watching, you pull up your price display terminals, your price displays on the terminal, and you immediately start watching the stuff, and you start forming views on the stuff. Okay, here you have crude oil, so you are closely following crude oil, and you're trying to make sure you understand, okay, you see this rising price, let's have a look at it, 3 months, let's go to 3 months. Okay, you see that the price is still rising. Okay, now you have to start following this stuff. You have to basically form a view all the time on the market price. What is likely to happen now? Is it going to drop? If you look at like a 1-year data, okay, and you have this big drop in between. Obviously no ads on any chart, right? Okay, you have this big drop when the Saudi-Russian discussions collapsed. Okay, that's when you got the big drop. Okay, so remember, so this whole idea of these projects, I'm just deviating a little bit. Why are we making you do all these live projects? Because these are live projects, these are not simulations, because so that you can have these experiences. Okay, nobody knew what would happen here. I didn't know this. The programmer of the software didn't know this. These are all real prices. The real world is happening, and we are all living in it and getting surprised by it. So you see what happened. You know that you were trading this project, you were working this project when this happened, that the Saudi-Russian talks collapsed and the oil price collapsed. Okay, they were trying to basically cut production. At this stage, they were discussing with each other. They were trying to cut production, and the talks collapsed. So they knew that production would not decrease, the excess supply situation would remain, and the oil price market panicked and they sold it off to zero. So you'll remember this. Historically, this is a significant time. So you'll remember what the news flow was when this kind of market move happened. Okay. Remember, it's not always guaranteed to happen like this. This is the beauty of financial markets. This is why you can't model this stuff, because 5 years later, there might be a similar situation. Saudi and Russians are discussing with each other for output cuts, and the output cut talks fail. And you see there is no chance of output cuts, but you're not guaranteed to get this kind of a move. The market may not react. So the market is basically, the market is completely whimsical, actually. There is no basis on which the market reacts. Sometimes there's no consistency. And that's the real problem here in the whole business of predictive modeling of financial markets, asset prices, that there is no consistency in how the market price reacts to certain types of news, like whatever, all the different types of news. So there's no consistency in the reaction, and that's why you can't really do predictive modeling. And that's why you can do it in the hard sciences, because in the hard sciences, we are dealing with things that do not change. They always react in the same way. So that you have to understand, okay? So just a little aside, but essentially going back to what you have to do, you have to identify the KRFs, talking to the sales team, which instrument is it that you need to focus on. In this case, we are assuming that it's front month futures. And then you start setting up your charts, setting up your price displays, setting up your charts, and start watching the market like a hawk and constantly forming a view, because you will have to take action based on your view. Constantly forming a view, what's going to happen? Is this going to just collapse now and go down? Or is it going to continue to move up to 60, 65, etc.? You have to constantly form a view, like you have done in your active risk book management cases, projects which you've done in the previous two courses, right? So this is why I make you do these projects, because in the real world as well, in most of the finance roles that you will be doing as an MBA student, that you could be doing, in most roles, you will have to take a view on the market, okay? All the time you're taking views on the market, and sometimes the views are not correct, okay? So you have to just live with it, manage the risk. But there is no getting away from taking views on the market in the face of uncertainty. You really don't have full information. You don't know what's going to happen. You have to make some reasonable assumptions, okay? So this is why we make you do these projects, so that you get the first hand. You're putting yourself in the situation where you're going to be exactly like you're facing the exact problems that a real world decision maker has to face. Okay, so that's what you do. Identify the risk factors. Start watching the market like a hawk. Okay, now let's discuss further. Now, Vipul and others have said that the exchange rate is also a factor. Yes, because if the exchange rate changes in such a way that the dollar value of the liabilities increases, okay, in that case, the outside liabilities figure will increase as total assets remains the same. Outside liabilities increases, that means net worth goes down, which means you're suffering a P&L component shows a loss. The P&L reflection of the reduced net worth on the balance sheet will be a loss, not a profit. So that's bad. So therefore, you have to now start watching. So the KRFs, as he correctly identified, okay, is the dollar-yen exchange rate. What are your KRFs? You have to set it up. Please remember to do this, because here, okay, although you'll be using here, so for hedging currencies, it's very interesting, okay? This is why you have to be familiar with how markets operate as well, the contextual knowledge. For hedging currencies, this is a peculiar case, because the spot market in currencies is the most liquid market, okay? So the primary market for, if you go back to the learnings, some of the theory that I've taught you, primary market for price discovery, okay? Remember price discovery? And primary market for price discovery. So if you're asking yourself, where is these prices being set? These foreign exchange prices, okay, which you see, where are they being set? Which market instrument combination is most important in setting these prices? And the answer is the spot market, okay? So you have to basically, so the way you do it is, I'll give you an example here. If we go back and try to open up the Netanya FX rates, I'll come to that. Now, this is an example of your spot market dollar yen chart, right? So you can look at, let's say you look at a 5-year chart, okay, dollar yen. Interesting how you see quite limited volatility in 5-year dollar yen, not a lot of movement, okay. So let's pull up the Netanya futures, the foreign exchange quotes, and then we are also going to put up CME. I'm also going to show you the currency futures. So we'll see what I mean by the primary market for price discovery. But essentially, what will happen is in the currency markets, you will see that essentially the knowledge that you need to have, your contextual knowledge that you need to have in the currency markets, is that the primary market for price discovery in currencies is actually the spot market. Although when you actually hedge, because of the constraints I put on you in this project, you will be hedging using futures contracts, which in the case of yen at least are quoted in a different way. So this is actually I've deliberately put in yen. Okay, Aussie, there is no difference in the way it's quoted, but I've deliberately put in dollar yen because I want you to get confused, and I want you to deal with that confusion in the way you manage it, because that is an essential part of the learning. Okay, how does it happen? Let's try to see if we have some information on currencies. They have not given us all the currencies. FX. Okay, here FX. Okay. So notice this. This is basically your right here. What you see here, majors, dollar majors. This is spot market prices. Okay, you have to understand. Okay, best bid and ask, top of the book. Remember these terms I taught you? I think I've taught you this term, right? Top of the book. Am I right? The top of the book, market depth, all these things we've learned, right? So you can see this language being used. Best bid and ask, okay? Real-time tradable rates, top liquidity providers. Which market is this? Which instrument is this? We know the markets. The markets are here. Okay, these are the markets. But which instrument is this? You have to know this as a, they may have written it, but if they haven't, then you know that these are actually spot markets. The top market in global foreign exchange is the primary market for price discovery in foreign exchange is the spot market. It is not futures, it is not options, it is not swaps, it is spot. Spot FX is actually the world's biggest market. They trade over $5 trillion of volume per day. That is 5T as in Trivandrum, okay? 5 trillion per day. So it's the biggest market in the world. So it's worthwhile learning about the market. And you can see how liquid the market is. It trades, how the spreads are down to, they're quoting up to the 5th decimal to be more and more competitive, okay? So this is where the primary market for price discovery is. So in the case of yen, there will be a difference. You will have to monitor your risk. That is, when you are tracking the dollar yen market, you will have to monitor the market and take your views based on the spot market charts, because this is how you should do it. Okay, this is where the primary market for price discovery is. Do your analysis based on the spot market charts. But later on, when you have to trade futures, okay, if you see, we have futures. Let's see if I can pull up the futures FX products in the case of the yen. Whether we have okay, it's a little difficult to navigate Japanese yen. We have that Japanese yen. Okay, let's look at that. But you'll see that in the case of futures, when you'll be trading, so this is how you form your view. Okay, so obviously you have to form your view because you need to enter some. You may need to enter some hedge transactions. Okay, now, but when you look at the hedging part of it, when you actually look at doing your hedge transaction, you will be looking at a situation where, look at this, I've now pulled up so you do your analysis looking at spot market charts. How are Japanese yen, this is the instrument that you're going to be using to hedge, okay? This is what you'll be using to hedge. We have this, I'll just finish in 1 minute, okay? Just to show you the problem. Okay, what is this? Now you see the price. You see how funny the price looks. You see how funny the price looks. Yeah, that's because the futures are quoted with the spot market trades with dollar as base currency in dollar yen. Okay, but the futures markets always trades with the foreign currency. These are all US based futures markets. They trade always with the foreign currency as the base currency. So that's why it looks so funny. All right. So this will create further problems for you. It will make it more complicated, but that's the kind of trading I want you to have. You will do the analysis, forming the view based on the spot market charts, but you will actually, when you enter the hedge, you should have to remember what you want to do, whether you want to buy dollars, sell yen, sell dollars, buy yen, whatever you have to do in the hedge transaction. When you come onto the futures markets, now it's trading with yen as base currency. Okay, so you have to accordingly do the transaction in the futures market, because that's your hedge transaction. That's what you're. So there's additional level of complication, but that's why the case is written in such a way to put the dollar yen in there, so that you are forced to deal with this kind of complication. Okay, we'll continue. The class is dismissed. Where will I? Yeah, the class is dismissed, and the rest of you can go, and you can stay back. Srishti will deal with your administrative question later. Does anybody have any conceptual questions? Anybody? Okay, no conceptual questions. All right. Okay, so 1 minute. So then I'm going to stop the recording.